There is a number that keeps a lot of smart people out of the market for years. The number is whatever the next great stock is supposed to be, the one your coworker is buying, the one a confident voice on a podcast says is about to run, and the quiet belief underneath all of it is this: to build real wealth in the market, you have to be smart enough to pick the right things at the right time. If you are not, you will lose. So you wait. You stay in cash. You tell yourself you will start when you understand it better. I want to take that belief apart because it is answering a question almost nobody should be asking. The question is not which stock. The real question is, how does ordinary money actually become a lot of money over a life? And the honest answer has almost nothing to do with picking winners. It has to do with owning everything, paying almost nothing, and then doing something that sounds too simple to work. Here is the real math. Start with the thing nobody wants to hear, including the professionals. Over the 15 years ending in 2024, almost 90% of professional large company fund managers failed to beat a plain S&P 500 index fund. Fewer than 1 in 6 beat it over 10 years. Push the window out past 20 years, and almost no one beats it after their fees. These are people with research teams, terminals, and full-time careers spent doing nothing but picking stocks. And the simple index, the one that just owns the whole market and does no picking at all, quietly wins. Sit with what that means for you. If the experts who do this all day cannot reliably beat the market, the odds that you will do it part-time, on your phone, between meetings, are not good. That is not an insult. It is freedom, because it means the winning move was never to be smarter than everyone else. The winning move is to stop trying to win and just own the whole thing, and owning the whole thing is now almost free. A single broad index fund holds a piece of hundreds of the largest American companies at once. When you buy it, you are not betting on one company surviving. You are betting that the American economy, taken as a whole, keeps growing over your lifetime. Some companies in there will fail. Others you have never heard of will become giants. You do not have to guess which is which because you own all of them. The winners more than cover the losers, automatically, forever, with no decision required from you. So let us talk about what owning the whole thing has actually done. The American stock market, measured by the S&P 500 with dividends reinvested, has returned about 10% a year on average since 1928. After you take out inflation, the real growth in your buying power is closer to 7% a year. Now here is the part that breaks people's intuition. That 10% average is almost never what any single year looks like. In 97 years of history, only 5 of them actually landed between 8 and 12%. The market gives you the average through wild swings, big up years, ugly down years, and long flat stretches. The average only shows up if you stay long enough to collect it, and staying is exactly where most people fail. This is the most expensive mistake in all of investing, and it has nothing to do with which fund you chose. Look at what happens when you try to be clever about timing. Over the last 20 years, an investor who simply stayed fully invested earned about 9.5% a year. An investor who jumped in and out and happened to miss just the 10 best days of the market earned about 5% a year. 10 days out of 20 years. On a $163,000 investment, staying put grew to over $1 million. Missing those 10 days left you with about $460,000. Less than half, because you flinched on 10 specific days. And here is the cruel twist that makes timing a trap. 7 of those 10 best days happened within 2 weeks of the 10 worst days. The huge up days are hiding right next to the scary down days. So the person who sells to escape the crash almost always sells right before the rebound. You cannot dodge the bad days without also dodging the good ones. They are the same storm. This is not a theory. It is measured every year. The research firm Dalbar tracks what the average real investor actually earns versus what the market handed them. In 2024, the market returned about 25%. The average equity investor earned about 16.5%. That gap, more than 8% in a single year, was not caused by picking the wrong stocks. It was caused by behavior, by pulling money out at the wrong time and easing back in too late. On $100,000, the buy and hold investor finished the year with about $125,000. The average investor finished with about $112,000. $12,000 gone in 1 year just from flinching. And the truly humbling part, the average investor has now underperformed the market 15 years in a row. The last time they won was 2009, so the enemy was never your stock picking. The enemy is you reacting, which means the entire skill of long-term investing collapses into something almost embarrassingly boring. Own the whole market through a low-cost index fund. Add money on a schedule automatically, no matter what the news says. And then, this is the hard part, do nothing. For decades. Let me show you what doing that actually produces, because the number is bigger than people expect. Take $500 a month. Not a fortune, a car payment many people already make. Invest it in a broad index fund and let it average 10% a year for 30 years. You will have put in $180,000 of your own money. You will end with about $1,100,000. Read that again. You contributed $180,000. The market added roughly $950,000 on top. You did 16% of the work. Compounding did the other 84%. You were not a genius. You were patient. Now let me show you the most important hidden lever, the one that costs nothing and almost nobody uses on purpose. Time. Picture two people who both invest $300 a month and both earn 9%. The first starts at 25. The second waits until 35. Same monthly amount, same return, the only difference is a 10-year head start. At 65, the one who started at 25 has about $1,400,000. The one who waited to 35 has about $550,000. That 10-year delay did not cost them 10 years of contributions. It cost them roughly $855,000. The early money had the most time to compound, and time is the one ingredient you can never buy back, and you do not need a big number to make this work. You need a long one. $200 a month, the cost of one nice dinner out a week, invested in a broad index fund averaging 10% for 40 years, becomes about $1,200,000. You will have contributed $96,000 of your own money across those 4 decades. Everything above that, more than $1 million, was time and compounding doing the heavy lifting while you slept. The amount mattered far less than the patience. So here is a question I want you to actually answer in the comments. What is the real reason you have not started yet, or started bigger? Is it fear of the crash? Or is it the feeling that you have to understand it all first? Tell me, because that belief is the thing costing you the most. Now the quiet killer that eats all of this from the inside. Fees. They feel tiny, which is exactly why they are dangerous. A 1% annual fee sounds like a rounding error. It is not. On $100,000 over 30 years, the difference between a fund charging 1% and one charging the almost nothing that good index funds charge is about $417,000 of lost wealth. Paying 1% instead of 0.1% quietly hands away more than 1/5 of everything you would have ended with. And you never see it leave. There is no withdrawal, no alert. The fee just skims a little every year, and that little would have compounded into a fortune. So the cheapest funds are not the budget option. Over a lifetime, low cost is the single most reliable edge you can give yourself, and it is sitting right there for free. There is one more force most people forget to account for, and it quietly decides whether you actually got ahead. Inflation. That 10% average return is the number before the cost of living rises. Strip out inflation and the real growth in your buying power has historically been closer to 7% a year. That sounds like a downgrade, but it is the whole reason you have to be in the market at all. Money sitting in a savings account earning almost nothing is not safe. It is slowly shrinking because prices climb every year while your cash stands still. The boring index fund is not the risky choice here. Staying in cash for decades, watching inflation quietly eat a third of what your money could buy, is the risk almost nobody names. Owning the market is how ordinary savings actually outrun the rising cost of a normal life. Step back and notice the shape of all of this, because it applies far past the stock market. The pattern is the same one: quiet wealth always follows. Stop paying for the illusion of an edge. The active manager, the hot stock tip, the clever timing, the expensive fund, these are all you buying the feeling of being smart. And the feeling of being smart is the most expensive thing in finance. The people who actually end up wealthy usually did the unglamorous thing. They owned the whole market, kept their costs near zero, automated their contributions, and then got out of their own way for 30 years. It is the same logic as renting the experience instead of owning the liability, as buying the boring, reliable car instead of the status one. You skip the part that feels impressive and keep the part that actually compounds. So let me give you the whole strategy in one breath, the version you could start this week. Open a low-cost brokerage account. Buy a broad market index fund with a tiny fee. Set up an automatic transfer on payday so the decision is made once and never again. Increase it a little whenever you get a raise. And then leave it alone through every crash, every scary headline, every coworker bragging about a stock. That is the entire plan. There is no secret fund. There is no perfect moment. There is no genius required. The right stock was never really the dream. A calm, automatic, growing pile of money that frees you from worrying about money. That was the dream. And that dream has a price tag a lot closer to a single repeated decision than to a lifetime of being right about the market. The only thing standing between most people and real long-term wealth was the belief that they had to be smart enough to beat everyone else to deserve it. You never did, and now you know the math. If this changed how you think about one expensive thing you have been telling yourself you can't have, there are a lot more of these, the real math behind the life you actually want. Subscribe, and let's keep decoding it together.